Morning. Our next topic is transforming the insurance business value chain, presented by Gupta and Ali Jamal. Rishabh is a manager at Deloitte Consulting based in Singapore. He has experience in IFRS 17 implementation, reserve valuations, technical premium pricing, insurance portfolio optimization, alternative risk transfer solutions, and data analytics. Ali is an actuary at Deloitte and has 10 years of experience in the insurance industry in both traditional and non-traditional actuarial remits. Rishabh?
Hey, thanks, Wilda. Let me start sharing my screen.
Fantastic, great. Thank you very much, Rishabh. Thank you very much, Velda, as well. And a very good morning to you all. It's an absolute pleasure to have the opportunity to talk to you today on the topic of transforming the insurance value chain. My name is Ali Jamal, and over the course of the next 30 minutes, Rishabh and I will be providing you with insights into how companies are striving to achieve operational excellence and how actuaries can help with that transformation. By the end of the presentation, we hope you have a much better idea of how, or essentially why insurers are looking to transform their businesses, how certain functions can be transformed and what good looks like. And then finally, the specific skills actuaries can bring to the table and how they can effectively contribute to this transformation journey. Naturally, if you've got any questions similar to the other sessions, there will be a Q&A at the very end. And we'll be more than happy to answer as many questions as we can in the time. Naturally, Velda has provided a brief introduction to ourselves, but before proceeding, we'd like to provide you with a bit more detailed introduction. So let me start. As mentioned, I'm Ali and I work within the actuarial and insurance practice of Deloitte Consulting in Southeast Asia. I'm a qualified actuary, qualifying in the UK. And I'm very proud to be a member of the Singapore Actuarial Society, the Institute and Faculty of Actuaries in the UK, and also the Swiss Association of Actuaries. By way of background, I've worked in the insurance consulting sector for the entirety of my career, helping clients achieve their strategic objectives. My work has involved supporting insurers with transformation initiatives. This includes both the actuarial function and also other parts of the business, strategy and growth, market entry, and the more traditional actuarial work. In terms of geography, I've experienced not only in Southeast Asia, but also widespread across the UK and also the wider European markets, in particular Switzerland, Liechtenstein, Germany, and also some experience across France and Russia. And while I've presented at a number of conferences in the UK, this is actually my first time presenting at the Singapore Actuarial Conference. So thanks a lot for having me. And I'm really looking forward to sharing some thoughts with you, which I hope will be of interest. Before we deep dive into what we want to cover, let me hand over to Rishabh to introduce himself.
Hey, thanks, Ali. So hi, everyone. This is Rishabh here. Very similar to Ali, I work in the actuarial and insurance practice of Deloitte Consulting. I'm a UK qualified actuary as well. And yeah, same, proud to be a member of the IFOA and the SAS. The Singapore Actuarial Society. It's my first time presenting at the conference as well, especially the Singapore conference. Looking forward to sharing some thoughts with you that we think are helpful. In terms of my experience, I've had experience across the UK, mainland Europe, South America. I've been working with insurance broker previously and a direct insurer in the UK. I focus on a lot of different insurance initiatives, which I think Wilda did mention earlier. And as part of the SAC, the Singapore Actuarial Society, I'm the chair of PI Claims Working Party and member of the SAC GI Committee. So let's do the presentation now.
Brilliant, fantastic. Thank you so much for that, Rishabh. So moving on to the next slide, setting the scene. So I'd like to start by taking a few minutes to set the scene and firstly to articulate some of the reasons why insurers are focusing on transforming their businesses. So as we're all aware, customers today are definitely leading more tech-centric lives. And the new entrants, the new insurtechs, have digitalized their operations to support with offering a vastly improved customer journey. Now, this ranges from offering more tailored products to faster underwriting and a more seamless claims experience. In addition, they're using new sources of data. So for example, if we look at the life and health sector, the introduction of wearables to not only offer a more bespoke service, but also improve insurance pricing. And on this basis, more traditional insurers really do need to play catch up. Now, until recently, the failure to actually integrate new tech or adapt to tech change did not significantly impact profitability. However, in our view, going forward, this will definitely change, and therefore tech-enabled delivery is a prerequisite to improve both top-line revenue growth, i.e. new business sales, and also bottom-line profitability, essentially driven by having a reduced cost base and having a better understanding of risk. So tech enablement will result in a significant shift in the existing operating model across all aspects of the insurance value chain. Now, what you can see on the slide here is that we've outlined some of these key parts of the insurance value chain, namely distribution, underwriting, claims management, and finally operations, which essentially encapsulates all back office functions such as finance, actuarial, IT, HR, etc. And for each of these areas, what we've included on the screen as one or two expected outputs following a transformation. So for example, sales effectiveness for distribution, under claims management, we've got things like reducing fraud and so on and so forth. And during this presentation, what we're going to be doing is deep diving into each of these areas and to provide you with an idea of what good looks like. Now, given there have been a number of discussions over the past couple of years with regards to actuarial transformation in particular, for the purposes of the session today, what we're actually going to do is look beyond the actuarial function. And therefore, we're going to look at things like claims, distribution, etc. Now, I'd like to obviously stress here that this does not take away from the fact that it's still critical for insurers to transform their actuarial functions. It's just for the purposes of today's session, we won't be talking about that. But naturally, if you do have certain questions on that, we'll be more than happy to try and answer them at the end. Now, before we actually proceed to looking at the various different areas of the insurance value chain, I also want to take a minute to think about how and why actuaries can help in this transformation. Now, historically, and still today to quite a great extent, there is this misconception that actuaries are individuals who can only support with traditional actuarial work. So for example, the pricing and the reserving. However, obviously with the emergence of big data, our roles have started to expand more into data analytics, and the business has started to see how we can bring about greater insights. However, still nonetheless, the value of actuaries in non-actuarial functions, it's not as apparent despite our broad skill sets. Now, what we should really be doing is striving to become a true strategic business partner who can actively contribute to various non-actuarial functions, essentially providing meaningful insights and facilitating transformation initiatives given our capabilities and being able to use data to expand an insurer's strategic options. So as insurers move more towards becoming insights-driven organizations, we expect actuaries to support in two particular areas. The first one being data, i.e. the ability to pinpoint to new data sources, being able to use the data that comes from those sources, advanced data analytics, and so on. And then that second area would be technology. So adopting new emerging tech, intelligent automation, robotics, etc. So we need to be in a good position to collaborate in that tech workspace in order to bring about value. So all in all, there's a lot that we can do and a lot that we should do. So the next thing we're going to do is provide you with a brief overview of where insurers currently are in their digital journey, and I'll hand over to Rishabh to continue.
Thanks, Alisha. So as Ali mentioned, before we begin how actuaries can help in business transformation, let's think about where the insurers are in their journeys of adopting new technology. So as part of Deloitte initiatives in this area, we did a survey across many insurers in Southeast Asia. The idea of the survey was to understand the maturity level of the insurers with regards to what areas of businesses they could transform. What are the new technologies they could consider? Where are they in the journey of transformation, and so on. Based on the feedback we got, we categorize their answers into 5 broad buckets. So first one, no action, where the insurers have not started on their journey and there's no real change in the business due to these technologies than before. Following, where insurers are actively looking at recent developments, but processes are largely the same. Proof of concept, where some insurers are doing a pilot for certain technology to improve specific processes. Beginning, where the insurers have already begun implementing a certain technology for a specific process. And finally, full adoption, where the insurer's processes are optimized. So insurer is well versed in using the new technology. So as you can see in the table, most of the responses are heavy on the left side of the journey. That is from no action until POC. So around 33% of the respondents have not started their journey of implementing any new technology. Around 22% are piloting a new technology, and in the early phases of the journey, they have experienced different levels of success. Of these, the insurers who have found success understand the difference between new technology and correct technology. So they indicated that their success was mainly due to focusing more on the correct technology and prioritizing the user's needs. Very few respondents have been following the development of new technology, and some of them have indicated a moderate success in their transformation journey. So overall, the response has not been very positive, but what is preventing the insurers to implement these new technologies? So if you look on the graph at the bottom, there are several reasons to it, like budget, resource constraints, or shortage of skill set, unsure of the benefit of new technologies, and no suitable technology. So for general insurers, budget is considered to be the largest barrier. The next potential barrier was the uncertainty of benefits from these new technologies. So insurers, they don't really understand, or they don't know how these new technologies can help them. So this suggests that the lack of clarity about the benefits from modernization are limiting insurers for implementing new technologies. So I guess now is the best time for us actually to partner up with other business functions and support the transformation journeys. So in the next slide, I'll talk about distribution and how actuaries can be relevant to its transformation. Okay, distribution. So broadly, there are three key business problems any distribution function aims to solve to meet their KPIs, which can be, say, what segments should I focus on marketing campaigns on and why? How can I provide the right products to the right customers at the right time? How can I manage and retain my agency force in a suitable manner? Now, ultimately, the aim is to improve sales effectiveness and boost revenues. Earlier, insurers didn't used to collect a lot of data with respect to sales and product campaigns, what makes them successful, how likely the customers are to buy a product, what is the general consumer trend in the market, how can the campaign be optimized to achieve maximum success rate. And even if they did, a lot of them, they didn't know how to use it. But lately, the insurers have been placing increased importance towards being an insight-driven organization. But this thought process from the management strongly supports that actuaries can help the distribution function. So with the use of all this big data, predictive analytics, actuarial skill sets, and the insurance knowledge, actuaries are able to analyze a large variety of data and gather valuable insights from it. They're able to quantify trends and transform them into practical strategies. Now, a lot of companies are realizing this and using predictive analytics and actuarial skill sets to transform distribution. And the overall response has been positive for these companies. So we did another survey to understand how predictive analytics and actuarial skill sets are helping the insurers in the region. Now, experience has shown that companies that have an enterprise-wide analytics policy in place have average annual revenue growth greater than 7%. Almost 28% of the insurers saw increased retention and improvement in lifetime value due to a focus on improving the customer experience. And about 74% of the insurers indicated that the use of information and analytics is creating a competitive advantage for the organization. So I guess the big question now is, how can we use predictive analytics to solve the distribution problems? So personalized marketing, omni-channel customer experience, social media analytics to maximize customer lifetime value, so assessing channel performance, agent selection, agent performance, etc., can help with agency growth and retention. And finally, prospect identification, customer segmentation, target marketing, and cross-selling could help with campaign targeting and management. Right, so to give you more flavor or an example from the industry, we helped one of the insurers. So they had a problem that they had incorrectly sold life insurance products to its non-life customers, which resulted in a surge of unhappy customers who had to go through a lot of invasive underwriting only to be declined. So the potential solution for the insurer was to rely on internal customer data and third-party databases to identify and rank non-life customers based on its predicted mortality risk. Now, this could have eliminated wasted efforts by both the insurer and the customers while restarting the insurer's marketing engine for life insurance product sales. So similarly, to give you another example, this time from agency growth, there was an insurer who used predictive analytics to score agents and determine the best customer agent match. This helped the insurer to identify skill gaps and pinpoint opportunities for training and development to improve agent performance. This also led them to evaluate data quality and identify variances in agent attributes that drive business outcomes. Okay, I'll talk about the next business function, which is underwriting. All right, so with the development in the insurance industry, underwriters are being challenged to move from hindsight, where underwriting decisions are evaluated after the fact, to foresight, where portfolios are actively monitored to understand the impacts of risks added to their books of business in real time. Now, in future, historical data alone may not be enough to underwrite the evolving set of risks, particularly in commercial lines, say, for example, cyber insurance, where any new risk is not known. And underwriters are continually doing research, insurers are continually doing research to understand what kind of cyber risks or cyber events there could be in the future. Moreover, the customers' worlds are changing. More people are becoming digital and interconnected via global supply chains. With this rapid digitization, the availability of alternative and predicted data is increasing, making risk selection increasingly competitive. As a result, underwriters will likely need to upgrade their tools and skill sets. You could argue that underwriting will always be partly judgment driven, where judgment is required in areas like assessing shifts in capacity, emergence of new risks, etc. But underwriting function will need to effectively combine data and technology with experience and judgment to manage portfolios and adapt to the changing market conditions. With the evolving customer expectations and the need for efficiency, a lot of insurers have been focusing on underwriting by upgrading their underwriting capabilities with more advanced technologies and expanded data sources. And actuaries, again, can help by using their skill sets and knowledge. So digital underwriting, if you look on the screen, can broadly be categorized into 4 phases. So phase 1, or automated underwriting. So this ensures consistent rules and quickens underwriting. Phase 2, which is the accelerated underwriting. This involves a digital submission with immediate issuance based on specific rules and models. Phase 3, which is personalized underwriting, which leverages on new sources of data and technology to develop risk categories. And phase 4, or continuous underwriting, which enables dynamic pricing products based on behavioral changes, providing so flexible coverage as per customer needs. And you can see that all these phases, they are ranked on the y-axis with increasing value across stakeholders. So as you move towards phase 4, the value is added more. So what can you achieve with digital underwriting? Digital underwriting can help you understand the customer more deeply and identify their risks more accurately. With digital underwriting, insurers could personalize the products with more specific product pricing, enhance controls and compliance, target specific clients and increase retentions. So there are a lot of ways the insurers can benefit from it. Now let's look at how we can reimagine or change or transform the underwriting value chain by breaking it into 5 steps. So if you look at the screen at the bottom, there are 5 broad steps, which is intake. Now this would involve submission extraction using optical character recognition, text analytics, natural language processing, data completion using image recognition, third-party data, and speech analytics. Misrepresentation of fraud detection using behavioral analysis. So once all the data is extracted, it's cleaned, the next part is triaging. Now this involves prioritizing our submissions based on traits such as likelihoods to buy or be profitable using machine learning or recommendation engines. Capacity management using digital workflow tools. Now the next part is risk assessment, which could involve automated and assisted risk assessment and tailored products and coverage recommendations using intelligent rules engine, virtual assistant, and machine learning models using third-party data. The 4th step would be pricing. This could involve using advanced and predictive analytics and price scenario modeling using machine learning, data visualization, and decision support systems. And finally, processing. Now, this would mean real-time binding, interim policy changes, renewals, account management using digital workflow tools to improve customer engagement, and transaction close process using virtual agents. Right, I'll now hand over to Ali to discuss more about the claims management part.
Right, fantastic. Thanks for sharing your thoughts on those 2 areas, Rishabh. Great, so now we're moving on to the next stage, claims management. So I would like to actually start by stressing the importance of this area, in particular for non-life business, given its short-term nature. Now, one of the main drivers for retention and loyalty comes from the interaction that policyholders have with insurers and the quality of that interaction. Now, one of these few touch points between insurer and policyholder is actually upon making a claim, and therefore it's pivotal to ensure that this part of the process is as customer-centric as possible. So now, before moving on to what good looks like, let's start to think about the typical challenges in this area. So obviously with non-life, given price sensitivity, claims management has been identified as one of those areas whereby expense can be reduced. Still, the claims management process is not fully automated. There are still some manual processes, therefore increasing time to process and pay. From a tech perspective, core systems are still proving to be a barrier to an enhanced digital experience. And then finally, COVID, as with everything, has brought about its range of challenges, and Southeast Asian insurers have not been immune to this effect. So if we take Thailand as an example, there have obviously been a surge in COVID claims, putting a strain on processing time, therefore resulting in an increase in customer complaints. And there have also been challenges regarding possible fraud. So given these challenges, let's actually start to think about what good looks like going forward. So we've broken down the claims process into 5 distinct steps here, as you can see on the screen, covering claims notification, triage and assignments, investigation and assessments, payments and settlements, and then finally claims management, which is more focused on connectivity with other business functions and reporting, etc. Given time, let's just touch on a handful of them. So the first one, claims notification. So in terms of what good looks like, let's start to think about first notification of loss. So let's think about having a multi-channel data in tech, as well as new tech to support with things like picture and video-based inputs for small claims. As Jeff actually mentioned in the previous session, telematics is something that can really facilitate and improve claims experience. And on the whole, having some sort of lower incoming customer contact. So the ability to use chatbots as much as possible can obviously accelerate the process and in many instances actually improve that customer journey. Let's touch on another one, investigation and assessment. So this is more around claims handling. So in an ideal world, what we would want to see is a straight through processing of claims via automation. Say, for example, as close to 100% of the standard claims can be no touch. So the objective here would be to achieve a low or no touch for the simplest of claims, with expert focus being placed on those more severe, complex claims. Also here, advanced analytics can really facilitate fraud detection. So obviously it goes without saying that a key way to reduce cost would obviously be to avoid paying out on fraudulent claims and also minimize the number of unnecessary investigations. So actually what we've recently done with a client is actually, if we think about what we've done in the health sector, we've actually developed an in-house solution which combines both client data with Deloitte data sets to understand the relationship between provider location and the expected demand for service. So we utilized an ensemble of analytical methodologies in order to assess providers for fraudulent claims. So what we did was we used a combination of this internal claims data and external demographic data, and our team developed benchmark claims rates for specific demographic segments. So this essentially provided a platform for estimating an expected claim rate for providers. By then comparing actual to expected claim rates, we're able to identify providers that had claimed significantly more than would have been expected based on their demographics, and thus provided a highly targeted list of providers for the client to investigate further. So that's one example of what we've done and what can be done by insurers in order to avoid fraud, or at least manage it as far as possible. And then the last part of this process I want to touch on is payments and settlement. So the use of new methods of payment on digital platforms will significantly enhance automation. Moving away from cash and check and making it purely cashless is obviously the direction in which the market is going. So before finishing on this slide, in summary, the ways to improve would be a lot around tech and process. So in terms of tech, actuaries themselves can support with advanced and predictive analytics, essentially harnessing the power of their data and making better decisions. And then in terms of process, automating that simple claims process is something that actuaries can get involved in, and therefore support in driving down costs and accelerating the process. So that's all I want to touch on claims management. Let's just quickly move on to the next slide. I am quite conscious of time, so I'll just spend no more than a couple of minutes on operations. Now, in terms of operations, what I want to do here is actually focus on the finance function, in particular financial planning and analysis. Now, as we all aware, financial planning and analysis teams are full of highly skilled talents. However, their ability to drive value is significantly hindered by cumbersome processes, not standard handle turning, and really a lack of innovation. So based on our discussions with clients in the market, what we've really understood as challenges are things around process inefficiency, so not having standardized processes which are very disconnected, resulting in extended lead times, a lot of disjointed and ineffective tech as well. So a bit of a mixed bag here. Some are saying that they've got the tech, it's just not well connected with other parts of their financial planning process. The others are saying that there is available tech out there, we're just not really using it. So there is a differing maturity level across business units and across insurers as well in the market. So not only are these challenges, but these are obviously key reasons for change. And management expectations are obviously growing as well, in particular with the implementation of IFRS 17. So what we need to do is really support the FP&A teams in order to become as efficient as they can. So before finishing off on this slide, what does good look like? So we essentially see a fundamental shift in what FP&A teams produce and how that is produced as well. So in terms of what is produced, creating outputs that matter. So only reports that add value and are required to meet the objectives of key stakeholders. And then in terms of what is produced as well, greater analysis and insights. So being able to do realistic, timely, and trusted regular forecasts, and allowing management to be able to access this data and insights easily by self-serving. In terms of how it's produced, streamlined processes, so improving the speed at which reports and KPIs are produced, having more trusted data, so a single source of truth to reduce any reconciliation issues, and drive trust in the results that are being produced. And then leveraging new tech. So various cloud-based tech exists for visualizations of data planning, forecasting, consolidating, and so on and so forth. So what you can see on the screen here is an example of next generation planning process. And this is something which essentially captures everything that we've just discussed. So we've got a few building blocks here. So the first one being data collection and inputs. So having automating it as far as possible. Then we've also got system generated baseline. So having internal and external business drivers to feed predictive models and produce a systematic starting point for plan generation. We've also got plan development here. So this needs to be as connected as possible across functions to forecast as seamlessly as possible. And then finally, that last building block is management reviews. So as I mentioned before, developing interactive dashboards and standardized MI to facilitate business decisions. So that essentially finishes that part of the insurance value chain that we wanted to discuss today. Rishabh, I'll hand over back to you to conclude the session.
Sure. So thanks, Ali. I won't take much of your time now. So to sum up what Ali and I have been talking about for the past 20-25 minutes, actuaries are the two strategic business partners that can help the business by leveraging the use of advanced technologies and modeling skill sets to transform different parts of the insurance business value chain. So we can use actuarial skill sets and analytics to convert sales insights into strategies, use advanced technologies and data to modernize underwriting capabilities, use advanced modeling, automation, and technology to improve claims management, and finally, leverage digital tools to drive efficiency and accuracy across financial planning process. So by that, I'll conclude our presentation today. If you have any questions, then yes, please feel free to ask that.
Thank you, Rishabh. Thank you, Ali, for your insights on the transformation of the business value chain and how we actuaries can actually step in with our skill set in distribution, underwriting and pricing, claims and operations. I think this ties in nicely with the first question, which is, where do you think actuaries in general may be lacking in skills or experience or mindset to become that strategic business partner?
Great, that's a very good question. Perhaps let me start, and Rishabh, obviously you can
Sure.
supplement there. So in terms of lacking skills, I think that in my personal view, actuaries have a very broad skill set. We've demonstrated over generations that we understand the financials of insurance companies, and obviously we've also been able to demonstrate our data capabilities as well. And we're all very tech savvy. So I think in terms of those core skills, we've got them in an abundance. I think the issue here is really articulating those skill sets to other business functions and to the key stakeholders within businesses. So I think that's where actuaries really need to focus. They need to essentially promote themselves within the insurance companies and make it very clear that we're here, we can help in all of these transformation journeys. You just need to utilize us.
Absolutely correct. Definitely agree with Ali on this. I would just like to add a bit more that as actuaries, we have all the necessary skill sets. It's just that we are seeing new breed of actuaries now who are data scientists as well. We already have that data science or statistics background. It's just a matter of making it a bit more in terms of data science. And we'll be able to help, I would assume, or probably all business functions in the insurance world.
Yeah, Agreed. I think the next question is a little bit, yeah, I'll read it because I don't think I can actually like summarize it. So price optimization um, is widely implemented in the insurance market. More recently, there have been cases where insurers have been criticized for making use of claims optimization, whereby claim amounts offered to policyholders are tailored based on a model's estimation of how likely a policyholder is to accept the settlement amount. What is your view on the ethical defensibility of this practice?
Quite a challenging question there, obviously, putting us, yeah, well, all I'll say, first of all, is obviously we don't want to get into an ethical debate over here. However, as we're all aware, insurance companies, insurers are one of the key cornerstones of the financial markets. And insurers do have a duty to policyholders and essentially all individuals in society. So what insurers need to do is obviously when they're adopting any of this new tech, they do need to be responsible. They need to, while I appreciate the fact that insurance companies are obviously in the business of making money, I think they've got a duty of care to policyholders, and they need to do what's right. And models shouldn't necessarily be based around how likely it is for a policyholder to accept that price. I think, as I said, I think responsibility is the key part over here, and insurers will, or they already do factor that in within their key principles, and that's something that definitely needs to filter through when it comes to claims.
Do have one question. So do you agree with this survey that you've done that companies cited in terms of the second largest barrier, that is, there is no suitable technology? Do you know if there's maybe a follow-up question? Do you know if there's any technology that's currently in the market or being developed? Do you agree with what the GI is saying?
So I think what I mentioned was the second largest barrier would be the uncertainty of the new technology. So there are technologies existing out there. The insurers at the moment, they're not very sure on which technology fits the best for their purpose. So for that to understand, they would need to have a big idea of what the problem is, what actually they want to do, and what is the best technology that fits it. It's not about whether the technology is new. It's more about whether the technology is correct for the purpose they're using. So that's probably the area where insurers are struggling a bit. But obviously that survey was done earlier this year, and it might be the case that insurers have progressed in the journeys of implementation. So with the maturing industry, with new technologies coming in, with new startups, with new insurtechs coming in, and expanding their footprint, insurers are coming to realize what are the new technologies out there and what can they do to solve their own problems.
Well, thank you. Thank you both. Thank you for staying on, everyone, as well.